Thank you to Harvest ETFs for sponsoring today's video. So Eli Lilly, Amazon, Microsoft, NVIDIA, these are some of the largest and most widely held US companies. There's good reason that these stocks are so popular. They've delivered consistent stellar growth and are well positioned to continue that into the future. In the current environment, investors also want income. Today, we're focused on a product that provides exposure to these core US companies through single stock ownership, but also while employing an active covered call writing strategy to deliver consistent income. I'm sitting down today with Harvest ETF's Chief Investment Officer and Lead Portfolio Manager, Paul McDonald, to talk about this exciting new product. Thank you so much for joining me, Paul.
Great to be with you, Mark. Thanks for having me.
You bet. I want to start, if you don't mind, with the big picture here. And HHIS, this is a brand new ETF. It's the first of its kind here in Canada. I wonder if you can please share for my audience here what inspired the creation of this fund, what makes it stand out in the market.
Yeah, so I'll take a step back, and HHIS is the Harvest High Income Shares. And so within that lineup, we actually have four different strategies. And so as you pointed out, we have four stocks that we've selected, Amazon, Microsoft, NVIDIA, and Eli Lilly. And so we own those individual securities in an ETF. Each one is an individual ETF, and then we write our covered call strategy. And so, how this has sort of evolved and the innovation that's happened here, it really comes down to having more choices for investors. So when we go back, some investors, they want to have a diversified portfolio of all the different sectors, and they'll buy it as a basket. Others want to allocate to a particular sector. Now, some investors want to have an individual stock. And so for sectors and diversified funds, there's been all kinds of ETFs that have been developed that have covered calls associated with them. And Harvest is one of the largest active covered call managers in Canada. However, this is the first individual stocks that focus in on covered calls. So owning the underlying individual share and having a covered call. And that really does the main thing there is you get exposure to the individual stock and you get that high monthly income. But it gives the investors that want to own an individual share that option now in an ETF wrapper.
I think back in the day when I was managing money and I would employ covered call strategies, Paul, and it was a lot of work for one guy to do. So you have your team there, but essentially that's what you're doing. You're providing this covered call overlay strategy for investors who might just be interested in owning, for example, Amazon, and putting that on top.
Absolutely, that's exactly what we're doing.
Nice. Well, I noticed at least at the launch here, you've chosen four of the largest, most widely held U.S. companies, Amazon, Microsoft, NVIDIA, Eli Lilly. Those are the foundation for the ETF. So I wonder what made you select these particular stocks? Is there some specific purpose for these four that you've selected?
Well, I think you hit the nail on the head. They're widely held securities. They're amongst the largest within their respective sectors, and they're dominant within those sectors. That's the primary reason, number one, on why we selected each one of these individual four. The second part to it, though, is on the option strategy. These are amongst the largest, most liquid options as well, where we can generate really attractive monthly premiums. So I don't want to oversimplify it. The widely held and very liquid options market that is now available in the ETF wrapper.
Yeah, it makes a lot of sense. Yeah, just given the liquidity that you have in there. I would like to talk a little bit about how the ETF works because it is, a little bit of a new thing here. My understanding is it combines the exposure to these companies we just talked about with that active covered call strategy. For those who are watching the video who might not be familiar, can you just take a moment and explain how this strategy generates the higher monthly income for investors?
For sure. So covered calls, they can be complicated. So I'll just kind of give a big picture. And if people want to learn a little bit more exactly how the structures work on covered calls, I know we've got a number of pieces that explain that. But in the short version is that if you own an individual stock, you can actually write what's called a call option on that security. And so by doing that, I'm giving somebody the right to buy my shares. And so I'm not doing that for free. They have to pay me for that, and that's called a premium. So the quid pro quo of that is when I get that premium, I forego the upside on that portion of the portfolio or the portion of the shares that I'm written. So one's able to generate some cash flow, but you don't get all of the upside. Now, within our portfolios, our right levels generally are between 33 and 50%. And so what that allows us to do is still generate some income, but still participate with that growth each and every month that we're writing the options.
Yeah, you may have just answered the next question I was going to ask you on this strategy, but yeah, I know that you're well, the 33 to 50% covered call target that you're using there, that obviously balances the income with the potential growth. There are a lot of ETFs out there that write a lower amount. You can even find some that write up to 100%. How does this 33 to 50% compare with using a higher or low percentage? What made you settle on that 50% level as a maximum?
Great question. So the 50% is actually the maximum. And so that's hardwired. We can't go over 50%. And the reason why we chose that was we always want to be having that 50% at a minimum each month that we're participating on the upside of the security. The actual right levels that we're doing each month are actually less than that right now. And so we set the initial distributions at about a 30% right level. And all that's doing is it allows us to have a fixed distribution. Some months we might be writing a little bit more than 30. Some months we might be writing less than 30, but it allows us to pay that fixed distribution and just gives us that little bit of flexibility. That way people can get the consistency and stability knowing that they're getting that fixed distribution.
That makes sense. So the main goal there is to make sure that the distribution is a consistent amount that people can rely on. And I guess different market conditions would dictate whether you'd go up or say as high as 50% to generate that income there. Is that fair to say?
Absolutely. And the mechanics of option pricing, it can be complicated. So volatility is a key one, where higher volatile markets, we generate more cash flow, more premiums. And that just gives us, as you pointed out, a little bit of flexibility to say, hey, you're going to be getting your fixed distribution, subject to a 50% maximum right level. And each month it varies, as opposed to having a variable distribution. It's the right level that's varying.
Nice. Okay, good. Thanks for clarifying that. One of the unique aspects I noticed of HHIS, of this series of funds you're having out, is that it is structured as a Canadian trust unit. And again, for our viewers watching this, can you explain the advantage of what the structure would be, and particularly for Canadian investors?
Absolutely. So I'll take another step back here and just highlight, although we have 4 individual stocks within the high income shares, there's a number of purchase options for each one of those stocks. So for example, whether it's Eli Lilly, there is the option to purchase it in Canadian or US dollars. And I'm sure we'll have a few moments to talk about having the lightly levered. So we do have a levered version, again, in US dollars and Canadian dollars. And so there's a number of series. Again, it's about investor choice. And so having it structured as a Canadian ETF also has some benefits. And so the tax treatment it's complicated, and each individual person should consult with their tax advisors. However, when we look at covered calls, they're typically treated as capital gains for most Canadian investors. And so that's part one. Now, part two is that as a Canadian listed ETF, it's considered Canadian property. And again, I don't want to get it overly complicated, but for some people, that actually may mean significantly less reporting requirements, given it's considered Canadian property. And so that might not be for everybody, but for certain people, they will be able to benefit from it being a Canadian trust. And if they still want to hold that position in US dollars, they also have that option, but still as a Canadian trust.
I'm just thinking, as you're talking here, Paul, on this video, we're talking about 2 of the most complicated things out there for investors, and that's the taxation, how those all work, and the covered call strategies for the average person. They can take a bit to wrap our heads around. So I don't want to get off on a tangent here, but just kind of dawned on me, oh yeah, these are things you could really go into the weeds with. You did mention the lightly leveraged, and I just wanted to make sure I covered that off today as well, because the HHIS offers that enhanced series that uses a 25% leverage component to it. For investors who might be curious, how does this leverage work? What are the potential benefits to a portfolio like this? And then, what are the commensurate risks that go along with that?
Yeah, great question. So again, we've got four different options for each security. We have the non-levered in Canadian, non-levered in US dollars, and then we have lightly levered in US dollars and in Canadian dollars. And that light leverage is approximately 25%. So it does change the dynamics of the underlying movements of the portfolio, as one would expect. You have 25% leverage. The key benefit there is that you get higher income because you're borrowing a little bit to invest more, and you get more propensity for the movements to the upside. Now, when we think about what's the trade-off for that, is that you would expect to have more volatility, and therefore one would also expect, therefore, that the risk categorization ought to be slightly higher. And so that's exactly how it is for our funds. Again, for those that are comfortable with modest leverage, we do have that option available for them. One of the key things I think that a lot of people should also consider is, how does that look on a compounding basis as well?
Yeah, I think of leverage and how powerful of it as a tool that it is, but also if you don't have safeguards in place, you don't manage it properly, it can also be a fairly risky thing to get involved with as well. So I think it's nice that I prefer for most people to pass that over to the professionals like you, rather than people taking on that risk and doing it themselves. When it comes to investing with leverage, is there anything specific, any specific considerations investors you think should keep in mind, especially in this format, in this type of ETF?
Yeah, so again, I'll just touch on the positives. You get that benefit to the upside. You get a little bit of enhancement to the upside compared to a non-levered. You generate a little bit more cash flow. You also benefit from institutional type of rates. Now, the quid pro quo, though, is that you do have more volatility, and so you do have the propensity, when markets correct on an individual stock, you perhaps don't get as much offset in other areas within the portfolio. So you will get that additional 25% downside. I think it's also important, when I mentioned the compounding, the benefit of that is that on the way up, we're resetting and we're managing that leverage ratio to 25%. And so as we go up, we'll continue to maintain that leverage ratio at 25%. And the flip side of that is on the downside, we'll keep that ratio in and around 25%. So you do have that compounding nature, both to the upside and downside.
Gotcha. That's sort of a natural segue, I guess, to my next question I had for you, Paul. But what would you say, or what type of investor would you say this ETF is most suitable for? Who would benefit the most from HHIS?
Yeah, so it really comes down to, when one looks at the individual stocks, and is this a stock that I want to be invested in? And do I want to have the high cash flow, high monthly income that's associated with the covered call? And I'm willing to forego some of the upside in favor of that tax efficient cash flow. That's the primary person. So you really want to have somebody that has an investor that wants to get that high monthly cash flow. And wants to be invested in the individual stock, and understands that they're going to forego some of the upside in favor of that cash flow. So that would be the primary person, I think, that is looking at these individual securities. And then I would suggest that part two to that would be, there may be somebody that is looking tactically and thinking one of the individual stocks maybe is going to go sideways and wants to maybe monetize some cash flow. There might be some tactical trading. I would say that's secondary, though, to the person that really doesn't mind giving up a little bit of the upside in favor of getting high cash flow from the option premium.
Gotcha. Yeah, it seems kind of like a bit of a niche here, where, like, I would say first and foremost, you have to want to buy one of those four companies. You have to own them, because you're owning them just with the extra, with the covered call overlay, and then the enhanced series. You have the leverage on top of that as well. Are there any additional factors that people should weigh in their minds before they make a decision when it comes specifically to the leverage? Or I think you may have covered that off already. Anything else you can think of?
No, I don't think so. I think it really comes down to, somebody has to be comfortable with the leverage component, and it works both ways. So if one's comfortable with that, then we have the US dollar and Canadian dollar versions available.
Right. Well, yeah, one of the benefits of this, I think you touched on this, just a few minutes ago about the flexibility in the currency options available both in CAD and in USD. Um, uh, you may have answered this, but I did have it listed down here, Paul, just in case you haven't or you want to expand on it. Why is that an important feature for Canadian investors? Is it the flexibility or more because of the tax benefits of that? Or say maybe you've covered that off already.
Yeah, I think you kind of hit the nail on the head again here, that it comes down to having the choice for the investor, and those particular tax benefits, not just from the option premium being taxed more efficiently, or potentially more efficiently, I
Right.
should say, and also potentially some reporting benefits. There's also some other ancillary benefits of, our trading prices are significantly lower than the underlying. So if somebody wanted perhaps to
Okay.
have a rounded number of shares, it's a lower purchase price for them. But I would say that's one of the ancillary benefits versus some of the others, that really this is about owning the individual stock, getting that high income and participating on some of the growth. But again, getting that high income along the way too.
That's the meat of it, right? But all the little bells and whistles don't hurt from
That's right. That's right.
incrementally as well. Um, if I look at it right now, and you're obviously very aware of this, there's been this trend almost in Canada to um, look for that higher monthly income from companies. I mean, the covered call strategy generally provides that. It's been very popular of late. I look at someone like in my demographic, retired, close to retired, and you're looking potentially for that higher monthly income. What would you say, if you can summarize it, are the key advantages, the key benefits to investing in this, HHIS here, especially for those who are looking to generate higher monthly income?
Yeah, it really is exactly that: tax efficient cash flow, listed on Canada, considered a Canadian trust. You have that option of having it in US dollars as well. So depending on where your retirement travel takes you, you do have that cash flow that you can generate in US dollars as well.
I like the travel reference. I like that. If I look down ahead, because this is a new product here, looking ahead, what is your company's outlook for HHIS? Are there any trends or market conditions that you feel would impact the performance of this or of these different options you have here?
Yeah, it's really each individual stock will have its moving dynamics, and so
Right.
we're very optimistic over the longer term, medium longer term here. The What's
Hmm.
happening with each one of these companies is there's a lot of exciting developments, and so what happens week over week. We utilize that information in our option strategy, but generally we're looking out over the medium longer term, and so from a negative side, if we have some movements within the market, macro events, they're always forever present. So when I look at it from kind of taking a little bit longer term view, for those that own these individual stocks currently or are looking to buy them,
Yeah.
here's another option for you. Here's a great way to get some high income and some tax efficiency to boot.
Yeah, I like that, and I just think of when people own those already, clearly or hopefully, those are companies that you've looked at, done your due diligence, and decided are suitable for you. So this just gives you another option to generate that extra income on there, or the leverage as well. Before I wrap up here, Paul, thank you for your time here. Is there anything else that you just like to take a moment that potential investors should know about this fund, which is very innovative? I really like what I'm hearing here. Is there anything else that you think people should know about?
Mark, I think we've covered a lot of the core aspects, and we do have a lot of information on our website as well for
Yeah.
those that want to look and see each one of the tickers. There's 4 tickers per underlying stock. Again, depending on which option people are looking to choose from. But I think we've covered a lot of bases here. It's innovation within the Canadian market. It's giving individuals the opportunity to buy exposure to some of the most widely held stocks and generate some attractive monthly income.
I think this is pretty exciting here. A new type of ETF as an option. The unique opportunities that this might offer for income-focused investors, particularly, I think is exciting. So thanks again for taking the time to do that.
That's great. Well, thanks again, Mark, for having me. Much appreciated.
You're very welcome. And thank you to everyone from our audience who has been watching. If you're interested in learning more about HHIS or how it can fit into your investment strategy, be sure to reach out. Of course, I will put a link in the description of this video. Thanks so much for watching. See you in the next video.